Derivatives are financial instruments used to hedge against market risk, such as changes in interest rates and currency exchange rates. They are known as derivatives because they derive their value from an underlying asset, such as a stock, commodity, or currency. Derivatives are traded on exchanges and over-the-counter (OTC) markets, with contracts negotiated between two parties. In this video, we will explain the basics of derivatives and how they work. We will also look at the different types of derivatives and discuss how they can be used to manage risk in financial markets. First, let's look at what a derivative is. A derivative is a contract between two parties that outlines an agreement to buy or sell an asset at a predetermined price on a specified date in the future. This underlying asset can be anything from stocks and commodities to currencies and interest rates. The price of the derivative is determined by the price of the underlying asset at the time of expiration. The most common type of derivative is a futures contract. This type of contract binds two parties together to buy or sell a specified amount of an underlying asset at a predetermined price on a specified date in the future. Other types of derivatives include options contracts and swaps, which involve trading one type of asset for another on a predetermined date in the future. Now that we understand what derivatives are, let's look at how they work. When two parties enter into a derivative contract, they create an agreement that outlines how much each party will pay or receive when certain events occur in the future, such as if the price of an underlying security rises or falls beyond certain levels by a specified date. If this happens, one party will owe money to another based on their agreement. This is known as settlement. The payment amount depends on several factors, including the initial agreed upon amount and any additional fees associated with buying or selling assets within their contract, known as margin requirements. Derivatives can be used for both hedging purposes, protecting against losses due to market volatility, and speculation, trying to profit from expected changes in prices. Hedge funds often use derivatives to reduce risk associated with investing in different assets by creating complex hedge positions that take advantage of movements in different markets simultaneously. Speculators often use derivatives to try and make profits from predicting changes in prices before they happen. These are known as derivative strategies. Finally, it's important to note that derivatives come with inherent risks that must be managed carefully before entering into any kind of agreement. This includes understanding what kind of risks you are exposed to if something goes wrong within your positions, such as defaulting on payments due to market instability or unanticipated events outside your control, like natural disasters. It is also important to note that anyone trading derivatives must understand all applicable laws related to these instruments before entering into any agreements. This includes understanding all relevant regulations set out by government or other regulatory bodies governing financial transactions over the counter or through exchanges like Nasdaq or London Stock Exchange, etc. Overall, derivatives can be powerful tools for managing risk in financial markets by allowing traders to enter into complex agreements without having ownership rights over actual assets. However, traders must always remain aware of their own personal exposure when entering into any kind deals related to these instruments so they can protect themselves from potential losses due to unanticipated events outside their control. Derivatives are financial instruments that derive their value from an underlying asset. They are used by traders and investors to speculate on the future direction of the markets, manage risk, and take advantage of price movements. Derivatives come in a variety of forms, including options, futures, forwards, swaps, and more. Each type has its own unique characteristics and uses. Options are a type of derivative that give the holder the right to buy or sell an underlying asset at a predetermined price on or before a specific date. Options can be used as a hedge against market volatility, as they provide downside protection while allowing traders to benefit from upside potential without taking on additional risk. Futures are contracts that obligate both parties to buy or sell an underlying asset at a predetermined price on or before a specific date in the future. Futures can be used for speculation or hedging purposes and offer traders a way to capitalize on near-term price movements without taking ownership of the underlying asset. Forwards are contracts between two parties in which one party agrees to purchase an asset at a specified price in the future. These agreements enable traders to lock in prices today that can protect them from unfavorable market conditions later on down the road. Swaps are agreements between two parties in which one party exchanges an asset for another asset of equivalent value over time. Swaps enable investors to diversify their portfolios without taking ownership of additional assets and can also be used to hedge against risk or capitalize on differentials in interest rates or foreign exchange movements. Finally, there are other derivatives such as warrants, spread bets, and binary options that offer more specialized opportunities for traders looking for more sophisticated products with unique features and benefits. No matter what type of derivative you choose to trade, it's important to understand how each product works and how it fits into your trading strategy before you start trading with real money. Make sure you understand all of the risks associated with derivatives trading before you get started, as they can be highly volatile instruments that carry considerable risk if not properly managed. Lastly, it's always important to use proper risk management techniques when trading any kind of derivative instrument so that you can protect your capital and maximize your chances for success over time. Derivatives are financial instruments that derive their value from underlying assets, such as commodities, stocks, or currencies. Derivatives have become increasingly popular in recent years due to the flexibility and potential for profit they offer. However, like any financial instrument, there are both advantages and disadvantages to using derivatives. The most obvious advantage of derivatives is their potential for profit. By leveraging a small amount of capital, investors can take positions on large portfolios of assets with the same amount of risk as if they were buying the underlying assets outright. This allows investors to gain exposure to markets they may not otherwise have access to or increase their returns on existing investments. Additionally, derivatives can provide protection against market volatility and even make money in a declining market by shorting a position and profiting when the underlying asset's price decreases. However, derivatives also come with risks, which must be weighed carefully before investing. One of the biggest risks associated with derivatives is counterparty risk, the possibility that one party will default on its obligations under the contract. Another risk is liquidity risk, the possibility that an investor will be unable to sell their position without incurring significant losses due to lack of buyers in the market. Finally, with many derivatives having complex structures and pricing models, it can be difficult for investors to adequately assess their risks prior to entering positions. One way to mitigate these risks is through proper diversification and risk management strategies such as hedging or using stop-loss orders. Hedging involves taking offsetting positions in different instruments in order to balance out potential losses when one position goes against you. Stop-loss orders are used to automatically close out positions if they reach a certain level of loss in order to minimize further losses. Additionally, investors should always ensure that they fully understand a product before investing as well as keep an eye on market movements so they can exit positions quickly if necessary. Overall, while derivatives can be an effective tool for traders looking to increase returns or protect portfolios from downside risk, it is important for investors to recognize both the advantages and disadvantages of using them before entering into any contracts. By understanding both sides of this financial instrument and following sound risk management practices, investors will be better prepared for success when trading derivatives markets. Welcome to this technical instruction video on derivatives. Derivatives are financial contracts whose value is derived from the value of an underlying asset or benchmark. The underlying asset can be a variety of assets such as stocks, bonds, commodities, currencies, interest rates, and market indices. In this video we will discuss the different types of derivatives and how they can be used in trading. Futures contracts are one of the most widely used types of derivatives. A futures contract is an agreement to buy or sell an asset at a predetermined price at a specified date in the future. These contracts are highly liquid and are used by market participants to speculate on and hedge against price movements in underlying assets. Another popular type of derivative is a forward contract. This is an agreement between two parties to buy or sell an asset at a predetermined price on a specific date in the future. Forwards are generally customized for each transaction and are not as liquid as futures contracts. Options are another type of derivative that give the buyer the right, but not the obligation, to buy or sell the underlying asset at a predetermined price on or before a certain date in the future. There are two main types of options: calls and puts. A call option gives buyers the right to buy the underlying asset at a specified price on or before expiration, while a put option gives buyers the right to sell it for that same price on or before expiration. Last but not least is swaps, which are agreements between two parties to exchange cash flows associated with different assets over. Swaps can be used for hedging purposes by locking in future prices, thus enabling market participants to protect themselves from unfavorable moves in commodity prices or interest rates. It's important to note that derivatives come with their own unique set of risks and that investors should be aware of these risks before engaging in any derivative transactions. Investors should also understand their objectives, tolerance for risk and time horizon when using derivatives, as there can be significant losses if not managed properly. Now you know about derivatives and how they work. Understanding how these financial instruments work will help you become more successful when trading them in financial markets.